Hey folks, Dan Frio here with your market update for August 5th, 2024. What in the world is going on? We got the markets just crashing everywhere around us. I want to put this in a little context for you guys because we have not so bad news coming out in the market. This could be fantastic news when it comes to first-time homebuyers. The reason being is we're going to see rates come down, and the rates come down quite a bit. You saw a huge drop last week. Look, mortgage rates on the 30-year fixed dropped 0.25%. Yes, 0.25% on Friday. Is that going to continue? I'm going to show you that. That's most likely going to continue. And then now what people are saying is, a couple weeks ago we were doing really well. Inflation was out of control. The economy's overcooking, and now all of a sudden there's a recession. Everybody's saying, well, there might be a recession. So one of the things I also want to talk to you guys about at the end of this video, what happens to real estate in a recession? Because you're going to see all these videos saying, okay, folks, here, it's the start of it again. Housing's going to crash because we're going into a recession. So I want to counter that right before that starts. But without further ado, let's get to the economic calendar to see what is really going on today. So if we go to the calendar, the only thing we have right now is some servicing numbers and things like that. There's nothing here to really make the markets crash the way they're going. Look at this. The Dow Jones, let's go over here. Dow Jones is down over 1,000. NASDAQ is down over 600. S&P is down over 3%. We have cryptocurrencies just crashing, but the silver lining here is oil continues to plummet, thus driving down inflation numbers a little bit there. So that's really all we have right now. But the concern is what the Federal Reserve is going to do next. So I want to go over to an interview with one of the former people that sat on the Fed. I know I do this a lot, but the nice thing is you guys are starting to learn and understand from former Fed officials the thinking behind the Fed. Okay, so we're going to go over that, and then we're going to come back and I'm going to show you how much room does the Federal Reserve really have to cut. And now, what does the CME FedWatch tool is telling us about what the Federal Reserve is going to do? Are they going to cut once, twice, 3 times? And how big are those cuts going to be? So let's get to today's agenda. So like I said, you saw the stock market coming off. We have right through here, Goldsby just came into the market this morning and said, well, if the economy starts to deteriorate, the Federal Reserve will fix it. How are they going to do that? Well, they're going to cut rates. But how much, when, all that other stuff, let's get over to here. We're going to go to a former Fed official to see what their take is. And then I'm going to kind of go like this when there's pieces of the puzzle I want you really to pay attention to, because we're going to talk about those after the video. So let's get to it, to the CNBC video.
Look at the Fed's future rate path, all of this following Friday's weak jobs report and then what is turning out to be a market sell-off this morning. Former Kansas City Fed President Tom Honig, he is now a senior fellow at George Mason University's Cactus.
Doesn't this seem like all these former Fed officials are some bigwigs at these colleges? Interesting.
Senator, I should say, joining us right now. Tom, it's great to see you, and I appreciate it, especially given where things are starting this morning and what we saw on Friday with the jobs number, and then this sell-off that seems to be spurred in part by some uncertainty in Japan that then sort of cascaded here. What do you make of what happened Friday, and what do you think of what's happening right now?
Well, I think, first of all, the economy is apparently slowing. I think everyone now recognizes that, perhaps, but that's as intended. I mean, the Fed's been in a relatively tight mold for some time to try and get the inflation numbers down. So I'm not sure anyone should be surprised by the numbers. It was a little bit on the upside, perhaps, but unemployment still 4.3%. Inflation still between 2.5% and 3%, depending on which of the two measures you look at. So we are in a slowdown period, and I think that's going to take us further down the road to getting price inflation down towards the goal. Now, the market is reacting, and the market was, many people thought, in a fairly frothy spot to begin with, so that's backing off. But I think the real economy is slowing modestly and will probably continue to slow, but it's not falling apart. I mean, GDP was up in the second quarter. Final demand, while it's leveling off, is still reasonably good. So those are important things to remember as well. And then finally, real interest rates, if you think about the rate, the Fed fund rate being 5.25% plus,
we're going to talk about
inflation 2.5 to 3. Real rates are still above 2%.
Right.
But I think that's by intent to bring it down. So there's probably room to cut, and I think the Fed will do that. But I don't think we should be panicked as much as the market
Tom,
suggests.
So they just keep rambling about why, what, when, and where, and how. So that's his take on it. He's saying, things are slowing. They were intended to slow. That's why the Federal Reserve kept raising rates to slow things down, and now it's finally starting to hit. So that's what we have right now. So what I want you guys to understand is he says, the nominal rates, basically the rates are a little still restrictive by the Fed. So here's what they try to figure out. Okay, the Fed effective Federal Reserve, the rate that the Federal Reserve controls right now is at 5.33, the federal funds rate, okay? Then we got inflation. Inflation right now they're saying is between 2.5% and 3%. We're going to say 2.97%, and this was done July, a couple weeks ago. Okay, so here's what they're saying. If you take the federal funds rate and subtract out the inflation rate that we're seeing right now, there's still a positive right through here, a positive 2.375. Okay, so that means the Federal Reserve has that much room to cut rates. So now they're contemplating how much is the Federal Reserve going to cut. And I got a kind of a scenario to show you right through here. What we're looking at right now is the CME FedWatch tool. Now this thing is really volatile, but I want to show you what has just been deleted, completely deleted from the chart. You go down through here. This is telling us what the federal funds rate is going to be, at the next few meetings. Basically, the next meetings going forward a whole year. Okay, so let's go back again. The federal funds rate right now is 5.33. Okay, so let's go down through here and see what it's expected to be. So you go through here, here's what the chart looks like, and you go over to here, and along the top through here, here's where the federal funds rate potentially could be. It caps out at 4.75 to 5, but the current rate right now is 5.33. Where did it go? Well, we don't even have 5%. So these go in, as you can see, they go in quarter increments. So we're missing 5 to 5.25. And then 5.25 to 5.5, where we're at now. Now they're saying there's most likely a 91% chance they're going to cut rates over a half a percent, which you're seeing right through here. Now, this is the CME FedWatch tool. I'm just giving you the data that's coming out right now hot off the presses. So that's what we're seeing there. So the next thing that now the crashers are going to do, they're going to find something to hang their hat on. They're going to say, okay, well, this is going to cause a recession. So in a recession, house prices crash. Well, let's see how true that is. I want to beat them to the punch. Okay, so let's go over to here and say, okay, and I use ChatGPT. What's happened to real estate values during the previous recessions? And I'm just plugging this in. So then it says the Great Recession, what happened? Well, house prices dropped 33%. And you're going to say, okay, Dan, there it is. It's going to drop 33%. Well, you can't just take 2007 to 2009 because that was a complete anomaly. And if you don't understand what happened during the Great Recession, you need to do yourself a favor and study that so you understand real estate and the cycles of markets, okay? But then let's go back through early recessions in the 2000s. What happened? Well, home prices continued to grow. Okay, that's kind of odd. And then let's go to the next piece of this. We go down through here. Early recessions in the 1990s. What happened there? Well, nationally, home prices experienced a modest decline. The downturn was relatively mild. Okay, what happened in the 80s? Well, in the 80s, there was a characteristics of high interest rates as the Federal Reserve was trying to combat inflation. Sounds familiar, right? Home prices were relatively stagnant. High mortgage rates suppressed demand, but prices did not fall dramatically. Seems interesting, doesn't it? Kind of like what we're in now. And I've been calling basically a stagnation in housing throughout the whole country. Now you're going to have pockets that get hammered, but nationally, you're not going to see a 33% decrease nationally. Okay, just saying, because you got to understand that. Now in the 70s, when everybody's saying, okay, this is the poster child of what went on, high prices experienced slow growth or minor declines in some areas. Brief and sharp with some regional impacts on real estate. However, the short duration limit and overall impact of the housing market really wasn't anything to write home about. So I hope you can understand what's going on. Even though with the markets just crumbling before our eyes right now, this is a correction, I'll say, in the markets. I thought the markets were pretty frothy, like the young man just said. So I'm taking this as a pullback, maybe a minor correction, but I don't think this is the catapult of, the whole market's deteriorating. And again, you're seeing mortgage rates come down right now. We have the MBS market. This was up about 20 something a little bit ago. So some of the servicing numbers that just came out has taken a little bit of bite out of this, but you're seeing mortgage rates basically staying stagnant right now. We got the MBS basically flat at 0. So mortgage rates right now are going to stay steady at 6.4%. Remember, just couple months ago, this was 8%. So that's what's going on in the markets right now. If you're in the market right now to maybe buy your house, buy a house, maybe buy your first investment property, or maybe looking to refinance at this point, because there's millions of people to close between October and like March, probably with high rates in the high 7s, maybe even low 8s. With mortgage rates like this, you might be able to save a little bit of money. But if you're contemplating buying a house, refinancing, or doing anything, please visit us at the Rate Update to learn more about me and my team. The first thing I want you to do, though, if you're looking to buy that first house, check out our grant finder right through there. It's going to help you find grants available to you guys it's going to take you probably 2 minutes to figure this out to see if you qualify for grants up to $6,500 that don't need paid back, and there's no lien on your property. It's basically free money to you. So check that out. If you'd rather just call us, say, Dan, I got questions. Can I just call? Yeah, you can call. Just scroll down to the bottom of our website, and you're going to see that number right through here, along with my email address. It is right there, 844-775-5626, or you can email me directly at dan@therateupdate.com. Thanks so much for watching, guys. God bless. Stay safe, and I'll be back at the closing bell to see how this fiasco ended for the day. Take care. See you then. Bye-bye.